Higher interest rates and runaway inflation have sent stocks down. So how long will it last? And better yet, how can you position your investments accordingly? Stick around for the answer. Dave Mazza with Direxion Investments joins us right after this. Welcome to the program. I'm DeLegge. It's great to have you watching. Be sure to subscribe to ETFguide TV and post your thoughts in our YouTube comment section below. Some investors have been caught off guard by rising interest rates and runaway inflation. Growth stocks and long-term bonds have been among the hardest hit areas. So how can you position yourself for the road ahead? Well, we're pleased to have with us Dave Mazza at Direxion Investments. Dave, it's great to see you again. Welcome back.
Hey, thanks for having me back.
So investors are concerned about runaway inflation. No one wants to have their buying power reduced. So what are some ETF strategies that investors can look at for hedging and for dealing with high inflation?
Well, they're concerned about inflation, rightfully so, because even though we saw a deceleration in the most recent CPI report, we're still close to 40-year highs, and a generation of investors have never traded or invested in this market, and which is one of the reasons why in the ETF landscape, we're beginning to see some interesting flow activity as investors look for opportunities to hedge their portfolio against the costs that higher inflation has. So, for example, folks who are interested in commodities, which historically have done well in inflationary environments, have been flocking toward our fund, the ticker COM, which actually provides a long, flat approach to commodity investing, meaning we're not just always going to own a basket of commodities. It's going to use the volatility of the underlying commodities, their trend, to identify which ones to have exposure to or not.
Yeah, and that's an underrepresented area in many investment portfolios, commodities. Let's change gears and talk about bonds for a minute. Bonds, the idea that they would go up when stocks fall has proven to be false in 2022. And it's caught, again, a lot of investors off guard. We see the Bloomberg U.S. Aggregate Bond Index falling over 10% year to date. That's a pretty big decline for bonds. Long-date U.S. Treasuries falling even more. You've got Treasury bearer ETFs like ticker symbol TMV, which have been top performers in 2022. So bring us up to speed on the trend.
Yeah, so it's interesting. On some measures, this is the worst ever year. Ever, like for hundreds of years, for the long bond, using data compiled by Robert Shiller. And what we've seen in this environment is really investors be extremely concerned about their portfolios because, to your point, you would think bonds would be that buffer, which they're not doing against a volatile equity market. And we have seen traders take advantage of this volatility and use our daily leveraged treasury ETFs, TMF and TMV, to trade the volatility that we're seeing in the treasury market. And I would note, again, these are tools for tactical trading. They're not buy and hold investments, but you don't necessarily need to sit on your hands in a period of volatility. You can, or you can take advantage of that volatility, which is one of the reasons why we're seeing folks use both the bull and the bear fund to take advantage of just the price action that we're seeing in the treasury market.
In August, Direxion launched the first single stock ETFs linked to Apple and Tesla. The funds are now offered in bear and bull pairs. So how do these ETFs work and who are they designed for?
Yeah, we're really excited about the introduction of our single stock leverage and inverse ETFs. And again, these are tools for tactical trading, but now we're applying the ETF structure in the leverage and inverse space to individual securities. So to your point, a trader can either take an amplified exposure to Tesla, and that fund has seen a significant increase in assets and trading volume as Tesla's been extremely volatile. And so if someone wants to express that short-term view, you can use TSLL to do that 1.5 times on a daily basis. Or let's say you're still a fan of Tesla, but you're concerned about what their most recent the vehicle deliveries will be. You could use TSLS to provide that short-term hedge. So we've seen a real strong interest among traders in these products. We're excited about where the market can go as we know that we both, in this period of heightened volatility, there's opportunities to take advantage of that.
Investors and traders with losing positions inside their taxable account should start looking at tax loss harvesting strategies. We've talked about this many times on the show. You've talked about it. Don't wait until it's too late when 2022 is over. So bring us up to speed. What is tax loss harvesting, and why does it make sense to do it with ETFs?
Yeah, so I think you're spot on. This year is, again, because you have both stocks and bonds down. Historically, folks didn't see an opportunity to tax loss harvest in the fixed income markets. And really what the idea is that if you have a position that's negative, you can rotate out of it, take advantage of potentially a lower cost vehicle or a similar but different exposure. And of course, I cannot provide tax advice. Everyone should be doing that on their own or with their advisor. But I would recommend not just waiting until December to look at your portfolio positions to see if there's an opportunity to rotate into a new area. And to your point, this year in particular, we are seeing investors really sell out of mutual funds and move toward ETFs as they become the vehicle of choice, both for index-based investing, but also increasingly for active-based investing.
Yeah, that's been a huge trend, seeing active mutual funds offer ETF shares or basically similar funds in the ETF format. Do you see that trend continuing in the ETF marketplace?
Yeah, I think this is going to be I think we're on the cusp of one of the greatest waves of adoption in the ETF space that the industry has ever seen. And folks could say, Dave, it's been happening. And I'd say, sure. But just like ETFs were first really kind of came to greater interest post the tech bubble, then really post the global financial crisis as ETFs proved their mettle in a period of really difficult market environment. We're right here again. I think we're going to see long-term investors say, hey, I'm going to finally get the opportunity to move out of these mutual funds that I've had embedded capital gains in. And then you're also going to see traders move toward ETFs, move toward leverage and inverse ETFs, as opposed to trying to trade meme stocks or cryptocurrencies, because those certainly have not paid off as folks have hoped they would.
Dave, thanks for your insights, and we look forward to seeing you again soon.
Thanks for having me.
Be sure to visit DirexionInvestments.com to learn more about Direxion's ETF lineup and strategies for positioning your investments for the road ahead. I'm Ron DeLegge. Don't forget to subscribe to ETF Guide TV. Thanks for watching. We'll see you next time.